Morning, everyone. Thanks for joining us for another episode of our Research Morning Call. Today we've got a few REIT updates and also Nvidia results, followed by our usual TA as well as macro and sector outlooks for Singapore REITs as well as for our SG REIT. So without further ado, I'll hand it over to Meow Meow to get us started. Thank you.
Yeah, thank you, John. Next slide, please. Yeah, for Sasseur REIT, our third quarter to three result were within expectations. Outlet sales up 15.8% on the back of successful promotional events. Sales for Kunming increased by 25.5% quarter-on-quarter in the face of completion of tenant rebalancing. Chongqing Liangjiang is still the proxy for retail recovery, with year-on-year improvement of 19.2% and contributing to 57.4% of the total sales. The portfolio occupancy achieved a record high of 97.9%. In third quarter to three, a total of 300 new leases were signed, including the 1,152 square meter super shop in Hefei, which had been vacant for 7 years. And some negative points about them is, firstly, depreciation of RMB could erode DPU further. RMB weakened by 8.2% year-on-year against Singapore dollar, and due to the 6th consecutive decline in export, we expect RMB could depreciate further. As for the outlook, management expressed confidence that the strong offline sales is less likely to be derailed by the e-commerce and streaming in China. Sasseur is also onboarding some new F&B and sports tenant to cope with the structural shift in outlet mall industry towards more experiential. Despite the typical seasonality, we expect the sales in fourth quarter to three will be on par with third quarter to three as a result of tenancy optimization. Therefore, our DDM back target price is still $0.9, remain unchanged, and the expected FY23 to FY24 DPU of 6.45 to 6.61 Singapore cents. Yeah, moving on to Lendlease. And next slide, please. Yeah, no financials were provided for first quarter to four. For positives, robust rental reversion of 16.3%, with Somerset achieving around 20% and GEM achieving high single digit. We anticipate some momentum of high reversion to persist. Somerset is benefiting from the return of tourism, and GEM is maintaining stability. Portfolio occupancy remains high at 99.9%, with Somerset experiencing a slight decrease of 10 basis points to 98.9%, and Sky Complex in Milan and GEM remain unchanged at 100%. There is no downward pressure in valuation in Singapore. The valuation of Somerset improved by 4% year-on-year as a result of the development of multifunctional event space, or Live Nation, which is expected to be in operation in 2025. The stress is more visible in overseas market. Sky Complex in Milan is valued down by 10.5% due to a terminal cap rate expansion of 75 basis points, as rental is currently under market rate. As for outlook, the management has indicated that there's no near-term plan for acquisition or equity fundraising, and it is still unclear that Sky Italia, the anchor tenant of Sky Complex Milan, will exercise the lease option in 2026. Yeah, but they'll provide a 1-year notice before doing so. The asset accounts for 13% of the total income, and Lendlease is willing to take back one building, around 4% of the GRI, to achieve a higher rental reversion, since currently the rental is under market rate. Yeah, but of course they'll have some downtime. As such, our DDM back target price remain unchanged at $0.86, with projected FY24 to FY25 DPU of 4.38 to 4.63 cents. Next slide, please. Yeah, we have a recent initiation of elite commercial REIT. Next slide, please. Yeah, it's a commercial REIT in the United Kingdom with 155 assets and market cap of 164 million pounds. Over 99% of the rental income originated from UK government, such as the Department for Work and Pension, around 93.2%, and Ministry of Defense, around 2.4%. We identify three investment. Next slide, please. We identified three investment merits. Firstly is the stable income stream with CPI-type escalation. In third quarter 23, DWP contributed to 93.2% of the portfolio's total GRI, and tenant is the government department with consistent record of paying 100% rental a quarter in advance. Elite has also has 139 assets that position to take advantage of the building rental escalation tied to CPI, which has already kicked in April 23. And the range for the escalation ranges from 11% to 15.4%. Next is divestment for monetization. It is also actively working on divestment plan to reduce the gearing. 5 assets has already been divested as of 9 months 23. The divestment 3.4 million was executed at 12.2% above valuation and contributing to a total gross proceeds of 11.4 million pounds, reduced the gearing by 60 basis points to 45.4%. And to account for a potential 5% decline in the year-end valuation, Elite may need to divest 10.8 million more assets. And 4 assets has already been completed for the dilapidation settlement and is ready to be sold and or to be relet. If Elite decide to divest them at book value, could potentially result in a divestment proceed of 13.8% and thus reduce the gearing by around 100 basis points. The buyers are observed to be the end user, acquiring the space for their own use, or the private developers for the residential development, as currently there's a shortage in UK. Last but not least, Elite now is trading at 0.59 times price to NAV, which is 1.13 standard deviation below the historical mean of 0.89, and is also very much below the average S rate of 0.86 times price to NAV, and taking the industry average multiple of and the NAV of 0.51, the implied share price will be 0.44. Much of the risk, such as the potential gearing breach, has already been factored into the current share price, and we believe the discount is attractive. Next slide, please. Yeah, there are some potential risks we would like to highlight. Firstly is the income risk. We saw 11 out of the 150 properties experiencing a rental reduction due to the increased shadow place. 3 of them reduced by 45%, and the rest reduced by 30%, summing up to less than 2% total revenue. The year-end valuation, as of last year, end of last year, was 466 million pounds, and the gearing now is 45.4%. Based on our sensitivity analysis, the gain would be 47.6% if the valuation fall by 5% at the end of this year. And it's very likely to breach 50% of the regulatory limit once the valuation decline by more than 10%. So we expect the decrease in valuation to mainly result by the expansion in terminal cap rate, which is tied to the SONIA rate. The SONIA rate was 3.4% at the end of last year, and is expected to increase to around 5% by the end of this year. So as such, we expect around 100% basis point in expanding cap rate to around 8.8%, and lead to valuation decline of 9.4% and gearing of 48.7%. Yeah, next slide, please. Yeah, as such, we initiate our we initiate coverage on elite commercial REIT with a buy recommendation and target price of 0.36 pound. Our valuation is based on DDM using cost of equity of 10.89% and 1% terminal growth rate. Elite is trading at 0.59 times price to NAV, which is below average S rate of 0.86 times price to NAV. At the current share price, Elite is priced at 16.5% forward FY23 DPU yield. Yeah, that's all for me. I'll hand over to Darren. Thank you.
Thanks, Mel. Yeah, so Prime US released their results earlier this month. So these are some updates. Yeah, the results were in line with our estimates at about 25% of our full year forecast. The gross revenue was down about 1% due to a lower occupancy, and the distributable income was down 23.4% due to higher interest expenses, as well as the fact that they are paying 100% of their management fees in cash versus 20% in 2022. And there's also an absence of lease termination income that was recorded in 2022. So for the positives, their leasing activities picked up in the third quarter. So for the third quarter, the leasing was more than all of the first half of 2023 combined, or rather the first 2 quarters of 2023 combined. Yeah, and there are also notable leasing discussions underway at some of their properties. But they noted that it takes a longer lead time to actually lock down those tenants because the discussions are taking longer than usual. They're also now focusing on net effective rents rather than headline rents, where deals with deals that require lower capex requirements. So for the negatives, their portfolio occupancy declined from 85.6% to 85%, so it's a slight dip. And going forward, it might dip slightly further because of Sodexo vacating their property end of the year. So we think occupancy will likely in 2024 remain around 80 to 85%, and perhaps towards the later end of 2024, it might recover. You might see some significant recovery to perhaps at 90%. That's our view for next year. And for gearing increased 0.9 percentage points quarter on quarter. So right now it's 43.7%. So now there is a 12.9% buffer from the FY22 year evaluations before the gearing reaches, or rather breaches 50%. So Prime is taking some proactive measures. So they might issue an EFR, an equity fundraising, or maybe a perpetual bond before the end of the year. So that they will at all costs avoid this breach of the 50%. So right now they have 78% of their debt on hedge rates, and the big thing for them is their refinancing of 69% of their total loans under their main credit facility. So this loans expires in July 2024. So they are in talks right now, ready to try to refinance this. So once they get this done, this will be a positive for them. Yeah. So as I mentioned, for the outlook, right now they're evaluating deleveraging strategies. So the big one for them is to prevent gearing, a breach in gearing for both the bank loan covenants as well as the MAS gearing limits. So we are expecting perhaps a 10% decline in property valuations as of year end. So right now their in-place rents are also about 6% below asking rent. So there's still some potential for positive rental reversions for them. And physical occupancy is expected to gradually improve over the FY 2024. Right now it's at 58% as more companies continue to mandate their employees to return to work. And one more thing to note is that Prime do not have any exposure to WeWork, which filed for Chapter 11 bankruptcy. So with that, we maintain our buy call on Prime, but we lower our target price because we factor in a weaker FY 2024. So we trim our estimates a little bit in FY 2024. And Prime is right now still trading at 0.25 times price to NAV. So we think this at this point is opportune time. Is very cheap in our opinion, because it's trading at a steep discount valuation. But we do know that a lot of the negatives are already priced in, like the negative US. We think it's already priced in. Yeah, that's why it's trading at such steep discounts. And some of the catalysts include improved leasing for them and greater return to office. And right now they're trading at a forward yield of about 27%. Yeah, next slide, please. So CLI also released their results. Next slide, please. Yeah, so for their results, the real estate investment business, it was down due to weaker contribution from divested property as well as lower performance in China. But the positive for CLI has always been their recurring fee business. That's part of the business that we like. So for the positives, their lodging management, their lodging segment was a star performer. So as you can see, it grew 31% year on year for 9 months, 2023. So this is all backed by the improvement in RevPAR as well as some more operational units for the 9 month. And right now, they are targeting 500 million in lodging fees within the next 5 years. So we think this target is achievable because for first 9 months, it's already 250, and lodging right now, there's a lot of demand for these assets. So we think it's a possible target, it's an achievable target. And for them, their recurring fund management fees also grew 9% year on year, as I mentioned before. And they have 10 billion of embedded FUM that's yet to be deployed. So once they manage to deploy this FUM, their total fund under management will reach 100 billion, which is their target. But they do know that it's a bit challenging for them to deploy funds in this current environment. So for them, they are also been doing some active capital raising. They managed to raise 3.5 billion of capital in private funds year to date. So this is 42% above total raise from FY 2024. FY 2022. So the 9 months is already more than 42% above FY 2022. And during the quarter, they also launched their new wellness and healthcare related fund. So it has an initial close of 350 million, and they're targeting about $500 billion. So half a billion, and they have an extension option to reach 1 billion if needed. So for the negatives for them, China remains a drag. There's still negative rental reversions for retail and office properties, and the only positive there is that new economy assets are having positive rental reversions, but it's still things in China are still slow and weak. And at year end, we expect the property valuation to decline, especially for overseas assets where there are cap rate expansions and interest rate due to high interest rates and such. Yeah, so but we think Singapore and India properties might remain stable, but the other geographies like UK, US, and China expected to kind of have some valuation declines as of year end. So for the outlook, we think lodging management it's expected to remain strong, and the recovery of event-driven fee-related income, we expect it to come back gradually in FY 2024, because this year the absence of this event-driven fee, so as a result, their fee-related business was affected, but the recurring portion of this fee-related business was the one that helped to stabilize the portfolio. And they have a target of 3 billion divestment target, but year to date, they only have divested 1.2 billion worth of assets. So they are likely to hit their target. And they have currently about 10 billion of assets that are sitting in the balance sheet that is in the divestment pipeline. So, and half of it is coming from China. So with that, we maintain our buy call with an unchanged target price, $3.68. Yeah, next slide, please. Yeah, so we had our Singapore REIT monthly update. So the third quarter results were under our coverage, mostly in line with our estimates. And so this is the dividend yield spread for October. The dividend yield spread is now at 3.5%. So it has ticked up from the previous month. So now it's at 3.5 and it's now at minus 0.7%, 0.7 times standard deviation from the mean due to the sharp correction after the FOMC kind of the previous, not the November one, the one before the November meeting. They had that very hawkish stance where interest rates were likely to remain high for longer. So because of that, share price corrected quite a bit, 6.9% for the month actually, month on month. Because of that, dividend yield spread has kind of spiked. If you ask me, from 3% to 3.5 is, I think that's a spike. So now we are seeing it to be more attractive to invest in as REITs. Yeah, next slide, please. Yeah, so forward dividend yield is also now at 6.9%. That is above the 1.3 times standard deviation above the mean of 10-year mean. All these are 10-year means, and the price to NAV for S-REITs are also now at a minus 6 times standard deviation, minus 2.6 times standard deviation. So this is also compared to the about 1.1 times average price to NAV for the S-REIT sector for the past 10 years. So this is really a steep discount to valuations for the whole S-REIT index. Yeah, and yeah, next slide, please. Yeah, so for S-REITs, we continue, or rather we maintain our subsector preferences in hospitality, because the recovery in visitor arrivals and RevPAR has been really strong. As you can see, the visitor arrivals, it did dip month on month because of seasonality, but year on year is still up quite significantly. And for the hotel RevPAR, average daily room rates are already at all-time highs, and the growth going forward will be from the occupancy. So right now it's at 82%, and you can see the RevPAR is still ticking up for Singapore. So this is one sector that we think the improvement in revenue can more than offset any operating cost increases and interest rate expenses. So yeah, you've seen it from the third quarter results where the hospitality REITs are the ones that managed to kind of grow their distributable income, or DI, compared to the other subsectors. Yeah, next slide, please. Yeah, and we also maintain our stance on retail, where we prefer retail sector because we think that the positive rental reversions are still intact. The retail sales index is still positive, 0.5% for September. It did slow month on month. Sorry, excuse me. It did slow month on month from 4% in the previous quarter. In the previous month. But we still think going forward it probably will remain around a positive, and this will bode well for the negotiations with tenants, where positive rental reversions as increase in rental is still expected, especially from over downtown malls, where the recovery of international visitor arrivals will help to boost the kind of demand and the sentiment there when doing the negotiations. And as a result, the downtown malls, we think they'll have slightly higher positive rental reversions potential than the suburban malls. But both suburban and downtown malls, we think they'll continue to have positive rental reversions going forward. And as a result, improvement in NPI. Yeah, so I think that's all for me. Oh no, sorry, there's one more slide. Yeah, so this is just an update of our coverage list, and there's some target price changes and some rating changes over the quarter as some S-REITs release their third quarter business updates, like Class and Prime US. We changed the target price. Yeah, but other than that, relatively similar. Yeah, so with that, that's all for me. I'll hand over the time to Glenn. Thanks.
Hey, thanks, Darren. Yeah, so for me, we have Silverlake Axis. So they released their first quarter FY24 earnings sometime last week. So Silverlake, what they do is that they actually provide core banking systems. So, in Singapore, they actually they do provide it for two of the local banks, two out of the three local banks. So that would be like OCBC and UOB. And then they also do it all over the region. So they're one of the larger players here in ASEAN. So anyway, just jumping straight to their earnings, their first quarter FY24 earnings of 48.9 million ringgit was slightly above our estimates, coming in at 27% of our FY24 estimates. And however, there was a dip of 15% year on year in their earnings, which came from lower than expected project-related revenue, as well as higher than expected OPEX. Now, for the positives, the first positive is that their recurring revenue rose 12% year on year, and recurring revenue comprises maintenance and enhancement services, insurance ecosystem transactions and services, as well as their retail transactions processing revenue. So for their maintenance and enhancement services segment, it grew 8% year on year to 124 million ringgit, and this was mainly from strong enhancements as well as change request revenue, as they continue to guide their customers into modernizing their core platforms, with growth coming from clients in Southeast Asia, the Middle East, as well as Europe. So, when Silverlake, when they do provide these core systems, they also have a sort of, I wouldn't say a monopoly, but the customers have to go back to them if they want to enhance it. Enhancements can include a lot of things. So things like AML, anti-money laundering updates, like the recent case that happened. So a lot of the banks came back and said, okay, we need to update our anti-money laundering systems, or they want to have a new product, let's say, or they want to integrate AI more into their systems. Then they have to go back to Silverlake and say, sorry, how much will this cost? And can you please help me do it? So that's why they do expect that this segment will continue to grow as more and new maintenance contracts and supports will commence when the current projects are completed and have been successfully handed over to clients. So it's sort of an ongoing cycle for Silverlake. So for the second part of their recurring revenue would be their insurance ecosystem transactions and services revenue. It grew 2% year-on-year as there was broad-based growth across all segments, from vehicle claims processing, insurance policies processing, and productivity and analytics solutions. For the last segment of their recurring revenue, which is their retail transactions processing, it grew 32% year-on-year, and it was mainly due to the increased usage and subscriptions to the new modules for their cloud-based retail solution, Agora Cloud. So as this is a usage-based model, they have seen increased usage from its existing base of 6 clients. So they are also looking to continue to expand their existing base of 6 clients. I think not too long ago, about a year ago, it was only 4 clients. So they are continually adding more clients as well as getting higher usage from their current base of clients as well. For the second positive would be that their order backlog remains healthy. They have a long track record and as well as a proven client base in Southeast Asia. As I said earlier, 3 of the 5 largest Southeast Asia-based financial institutions use their core banking platform, and they've also largely retained all of their clients since bringing them on board to their platform. Their current project pipeline is healthy at 1.8 billion ringgit, which is higher than the previous quarter's 1.5 billion ringgit. With contract wins of 125 million ringgit in the first quarter, as well as an order backlog of 720 to 730 million ringgit going into the rest of FY24. They also do expect revenue from their multi-million 10-year core and channels digital banking Mobius deal with a client in Malaysia to continue to come in FY24. As for the negatives, the first negative is that their operating expenses were 13% higher year-on-year, mainly due to annual salary increment post-pandemic, which was effected in the third quarter of FY23, as well as new headcounts added to support the business development and business expansion, sales and market coverage. So as the borders start to open more, they are beginning to see more need to expand, and hence this increase in their OPEX. As a result, their expense over revenue ratio rose to 31% as compared to 27% a year ago. But however, if you compare quarter on quarter, especially the last 2 quarters, in the third quarter and fourth quarter of FY23, the OPEX was stable. And the management did mention that they do not expect the OPEX to increase quarter on quarter going into the rest of FY24, as they have no current plans for further headcount increases. For the second negative is that their project-related revenue fell 12% year-on-year. So this comprises their software licensing and software project services. The software licensing revenue fell 66% year-on-year, as in the previous year, there was this large software licensing transaction from a client in Indonesia. So hence, if you remove that, actually their software licensing revenue was flat or even rose a little bit. As for their software project services revenue, it rose 137%, mainly due to new revenue flow from services contracts closed in FY23. As for the outlook, they continue to build a higher quality order book, and they have a tender book of 1.8 billion ringgit going into the rest of FY24. And more than half of it is coming from their core banking systems, which is Mobius and Symmetry, as well as some coming from their legacy core banking, which is SIPS. And while this initial revenue from these systems may be smaller as compared to the legacy core banking, which is SIPS, we do expect it to improve the recurrent fees. As what I said earlier, the maintenance enhancement fees will continue to improve with these new core banking systems. The second part is that they have also seen visible growth from new product cycles. They did sign a deal with one of the largest banks in Thailand, as well as the client in the Mobius deal with the client in Malaysia. And with this collaboration with the Thailand bank previously, they have shown that the proof of concept for Mobius and is a significant reference site for it. So we could see more inquiries going to the rest of the year as well as into the future. And there's also a large potential for replacing core banking systems with Mobius, as several legacy core banking systems are approaching the end of life. and hence the banks are seeing fewer limitations to adopt a fully cloud-based core. I think previously the banks, as in the older banks, what they've seen is that they are quite afraid to change to cloud-based core because of firstly the cost, as well as it's quite new and they are afraid that it might not perform as well as the legacy core. But now, with the fact that their legacy core banking systems are approaching end of life, they have no choice. So would they want to try something new? And they're also using the bank in Thailand as well as now the client in Malaysia as a sort of a reference site to show that it works. So as such, we maintain a buy with an unchanged target price of 38 cents, and our FY24 estimates remain unchanged, with our target price pegged to 20 times PE. And in our view, Silverlake should trade at a higher premium to its historical PE, with a new product sales cycle underway from its cloud-based software, Mobius and Symmetry, as well as the resumption of bank IT spending after the pandemic. So that's all I have for Silverlake. I'll now hand it over to Zane for the technical analysis.
Thanks, Glenn. I'll move on to TA. For S&P 500, last week we continued to inch higher. So we are now close to about 4,560. So for this week, we could see some continued consolidation ahead as the index continues to grind higher. So for now, the current resistance could be at 4,540 to about 4,600. That will be a retest of the year high level. For the immediate support will be around 4,460 to about 4,510, with the 4,500 level being the recent resistance breakout last week. Next slide. For individual counters, the first one we have is a technical buy for yen lot. So at 59.5 cents, with take profit levels at 67.5 cents and 71.5 cents. Stop loss can place at 56.5 cents. The stop loss closed at 60.5 cents on Friday. So looking at the chart for yen lot, there was a breakout of this downtrend resistance line, as well as being supported by a short-term uptrend support line in the process. In terms of the MACD and RSI, they are also showing increasing momentum following a period of bullish divergence. So with that, potentially the price could break out of the 62 cents near-term resistance to try and retest these prior resistances. Next slide. The next one will be Sembcorp Industries. So for this, it will be a technical buy at $5.11 with take profit levels at $5.64 and stop loss at $4.90. The stop loss closed at $5.13 on Friday. So for Sembcorp Industries, following a breakout of this downtrend, the descending wedge, there was a period of consolidation in the bullish pattern shown in the chart, and it looks like price has tried to break out of it with increasing momentum on both MACD and RSI. So should the price continue its bullish reversal, potentially it could go to retest the 564 level, which was the high seen September this year. Next slide. So this is just a summary of the trades initiated last week based on these two counters. Currently are both in progress. Yen lot is up about 1.6% and Sembcorp Industries is up about 0.4% as of Friday. Thanks. I'll now pass on time to Jonathan to talk about Nvidia results.
Thanks, Zane. So we'll just jump into the results for the third quarter of 2024. Okay, so for Nvidia, it was just another really strong quarter for them. Results really exceeded expectations, which is saying a lot because expectations were really quite high. Obviously, the biggest thing that you see here is revenue that actually tripled, slightly more than tripled year on year. Most of this was actually driven by growth in its data center business. So when you talk about data center business, for Nvidia, it's not really the data center itself, but they actually provide a lot of the hardware that is used to actually run the data center. So for this instance, it's mainly their GPUs. When you talk about their GPUs, it's their A100 and their H100 and their newly launched H200. So these GPUs are quite different from just your traditional PC GPUs because they're way bigger. They're essentially 8 to 10 normal PC GPUs kind of housed together in one bracket and is able to perform a lot, I guess, a larger workload compared to what the GPUs in our normal PCs can do. So what's really driving the demand is really a lot of continued investments from a lot of, I guess, tech consumer companies and other enterprises. They're investing heavily in this so-called accelerated computing. So essentially, it's just higher level computing, and they're using this a lot for inferencing their large language models or LLMs, as well as a lot of the generative AI applications. Um, so not only that, but uh, because they're investing a lot in this, a lot of their hyperscalers are actually forced to expand data center capacity, so they need more hardware, so they kind of basically only order from Nvidia. It's either Nvidia or AMD, but Nvidia is really the main player for right now. And so you've got demand from these kind of clients. At the same time, you've got demand starting to build up a lot from a lot of other, I guess, sovereign nations. So they mentioned in their call they're working with the Indian government to do a lot of building up their own AI infrastructure, their own LLMs, as well as generative AI products. And so as we see more and more nations come on board, definitely the demand will continue to increase because the demands of a nation are way bigger than just a single entity for the most part. Yeah, so that's really what drove most of the growth for the quarter, and is expected to drive most of the growth moving forward. The big negative for the quarter was actually the impacts of the US export controls to China. So actually, China makes up about 20 to 25% of revenue for its data center business. And essentially, because of these controls, so they're essentially banning exports to China unless you have a license, especially for higher end products. And because this was enacted fairly quickly, a lot of the companies that export to China don't really have the time to create new products or apply for licenses to actually get it done. So essentially, what's going to happen is that they're not going to export anything to China for the fourth quarter, and this is actually has been built into fourth quarter revenue guidance. The I guess the long term impact is still very unclear, so because there's very limited visibility on how this will play out. Because when it comes to China, it's very easy for a lot of these Chinese companies to essentially just steal away all the market share. They can easily just replicate what you're doing for the most part. So it wouldn't be too, I guess, out of the ordinary if Nvidia stops exporting to China for a while, and then this gives some Chinese companies to build up their GPU capabilities and actually start to support domestic China demand. Then you essentially lose the whole Chinese market forever. Although this is, I guess, for right now, it's not. It's very unclear how this will unfold. It is still a possibility. That being said, revenue guidance for the fourth quarter is still extremely strong. Growth is expected to continue to accelerate into the fourth quarter, which is quite crazy. 231% year-on-year growth for total revenue. So it's actually a data center is going to grow like 300%, which is significant. I guess a significant jump in demand. And like I mentioned, even though the expectations are fairly high, we think that it's still quite sustainable, at least in the near term, because there's so much demand. There's such a backlog for orders, as well as increasing customer commitments for how many I guess GPUs they want to buy in the future. And so this is really popping up, and Nvidia themselves are very confident of meeting these expectations. The biggest constraint to growth right now is actually supply. So similar to, I guess, companies like Tesla, the supply is it's not limited, but it's definitely less than demand. So Nvidia is actually working with a lot of its suppliers like TSMC to I guess to increase the kind of supply that they get from them to fulfill the orders that the clients place. And so they've been working every quarter on increasing supply, and we will expect that to continue moving into 2024 or calendar year 2024. So based on that, we actually maintain our buy recommendation, but we raised our fiscal year 2024 revenue and PATMI, which actually ends in January 24, by 13% and 27%. We also raised our DCF target price to $685 up from $645. So that's all for Nvidia. I'll move on to my next startup, which is TDCX. So TDCX is essentially an outsourced customer experience company. So their main business is omnichannel CX, which is, I guess, like your higher end call center business. So revenue for or earnings for them results for them were, I guess, hit and miss. Revenue was in line with expectations, which wasn't great. I mean, it was a decline year on year, and this was mainly dragged by a decline from its top two clients, 20% year-on-year decline from its top two clients because they were reducing seats and volumes, which was already conveyed earlier in the year, but there's still a significant impact on total revenue growth. On the flip side, earnings were actually significantly better, and this is good and bad because it's good on an operational front when you just look at the financials, but it's bad from a growth perspective because how TDCX actually grows is by growing headcount and growing their volume and seats. So essentially, when you look at earnings improving because of lower headcount and lower taxes, is a little bit of cause for concern on the growth front. But that being said, they also did have a lot of cash, so they were able to use their cash and increase their interest income by about 2.5 times, which is quite significant. It is one of the biggest reasons why their earnings actually grew 2% compared to revenue that was down 5%. In terms of outlook and guidance, guidance for the fourth quarter and for the full year 2023 was roughly unchanged, which implies a flat to slight negative year-on-year growth for the fourth quarter coming up as well. I guess the biggest bright side is that its smaller clients, which essentially are revenue excluding the top 5 clients, continue to grow fairly quickly at about 50+% compounded growth rate over the last few years. And we do expect this to continue moving forward because generally these are smaller accounts. They start small and then they grow a lot quicker than a lot of the bigger clients that already have been there for quite a while. And so TDCX has actually been expanding quite a lot into different verticals and geographies over the last few years. Revenue contribution from its top 5 clients have actually been decreasing over time, and we expect this trend to continue, especially as these kind of clients aren't really growing that fast compared to the rest of them, the rest of the smaller clients. So this will be a positive, maybe not so much in the next 6 months, but probably in the longer term, maybe 1, 2, 3 years, because it takes time for TDCX to expand their contract volumes because every contract is renewed on a year-on-year basis. So you essentially have to wait till the end of the year and then see how well they've done in terms of performance, and then renegotiate contracts to see if their clients want to expand and grow them as well. In terms of valuations, we actually still maintain a buy, but we reduce our target price to $8.60. The main reason why we maintain a buy is because we think they're actually significantly undervalued. If you look at 4P right now, I think they're slightly below 10 times 4P, which is moving into a fairly value territory. At the same time, about 40 to 45% of its market cap is in cash. So in terms of how the market is really valuing them, we feel that it's quite undervalued. That's why we think that they still have a very strong foothold in Southeast Asia from a CX perspective. It's just I guess as everything has kind of gone down over the last couple of years, it's just gone along with it. But conversely, when things start to pick up again, then they're still well positioned to capture a lot of the market share from its competitors. So that's all for TDCX. I'll now move on to SGREIT. So in terms of some of the macro stuff that was going on last week, GDP numbers came out for the third quarter. It was quite encouraging. They beat estimates of 1.4%. Q-on-Q growth beat estimates by 1.1%. And it was its second straight quarter-on-quarter improvement since the first quarter of this year. So I believe the first quarter was a slight decline, and then last quarter was fairly flat. And so we are starting to see a little bit of a pickup in terms of GDP, which is good for the overall economy. It might not seem like it, but at least it's some sort of green shoots to look forward to. In terms of core inflation, this number came in at 3.3%, slightly higher than estimates of 3%. And it was actually a slight tick up from the September numbers of 3% as well. It was its first reversal, it was first tick up after 7 months of decline. And even though it is a slight tick up, we are not really too concerned because the general trend is still going down. So we would expect core inflation to continue declining, mainly due to high interest rates and a little, I guess, slightly lower economic activity. In terms of your T-bills that came out, the 6-month T-bills, the yield was cut-off yield was 3.8% versus the last cut-off yield of 3.75%. Generally, since July or August, it's been hovering around 3.8%, mainly due to interest rates that have remained fairly high and fairly steady, with no real sign of any rate cuts in the near future for at least for the Singapore perspective. In terms of the US macro, existing home sales were really poor. It was its 8th month of decline, and we'll show you a chart later to just illustrate how bad it's been. And this has mainly been due to sky high mortgage rates that have been quelling demand quite significantly. In terms of durable good orders, this number was also pretty bad, down 5% month-on-month. It was its largest fall since April of 2020. So a fairly significant number that was quite poor. One thing that was actually pretty positive was initial jobless claims. The 209,000 was actually significantly less than expected, and significantly lower than the previous claims week, which was 233,000. So essentially, what you're seeing is the job market still being fairly tight, although it is softening a little bit. We still think that because jobs are still fairly tight, the economy by right moving forward should still be in a fairly good place. Yeah. So moving into our equity strategy, we still think that the cooling labor market plus the sliding inflation essentially has affirmed our view of no more rate hikes for the rest of this interest rate cycle. But the question still remains of when will they actually cut? And that's something that I guess only the Fed really knows. Or maybe the Fed doesn't even know themselves. But essentially what we're seeing right now with high interest rates and what we've seen for a while is that the US economic activity has remained fairly muted and it hasn't really been doing much. You look at the composite PMI is at 50.7, so it's not really growing, not really contracting either way. Our view is that the longer the Fed keeps its restrictive policies in place, we think that there's a higher chance of recession occurring possibly in the next year or so. Which it sounds fairly straightforward, but yeah, it just increases the chances given how restrictive the policies have been so far. And generally when you're looking at trying to figure out how effective the policies have been, it's not really a straight line decline, or sometimes declines can be a lot more severe, and then it'll end up that the Fed's going to be too little too late again, or rather too much too late again. Yeah, in terms of China, we still think that it's quite a decent trading opportunity. The government actually mentioned last week that they're planning to essentially bail out about 50 struggling companies. They're going to reduce a lot of the financing requirements for them. Most of these companies are in the property sector, and which has been a concern for the last, I think, 1 or 2 years. So they're really trying to contain the meltdown, the potential meltdown of the property sector, which could spill over into just the overall economy. At the same time, they've also set some, I guess, 2024 GDP targets, growth targets of 4.5% to 5.5%. So it's quite significant growth targets. If you take this at face value, it basically implies that they're going to need more stimulus to reach these levels, which should be positive for the Chinese equity markets, because if the government's going to be supporting it, then it's going to be very difficult if you try to fight the government. Yeah, so that's all for our equity strategy. When it comes to what kind of events are coming up for this week, for the US, most of the earnings coming out are from your big SaaS companies, so like Intuit, CrowdStrike, Snowflake, and Salesforce. The core inflation numbers are coming out, core PCE numbers are coming out on the 30th of November, before I believe, before market opens. But we think that this should be in line with the CPI numbers that came out a couple of weeks ago. In terms of our corporate insight webinars, we have First REIT tomorrow at 3 p.m. While we have Crom REIT, Uni Asia, and IWOW next week. Yeah. So this is just a chart of your US 30-year fixed mortgage rate versus home sales. So the fixed mortgage rates in orange, and then the home sales are the columns in blue. You can see it like since end of October 2021, when mortgage rates started really climbing, you see a sharp decline in home sales. Right now we're at levels almost its lowest levels in 10 years, which is quite significant. It doesn't really look like slowing down. And so it really just goes to show that what these rising interest rates have really been doing to the real estate market in the US. Like I mentioned earlier, your composite PMI of 50.7, when you break it down, the manufacturing is still contracting while services are still kind of hovering, somewhere around 52. Basically 50 is your baseline. Anything above 50 is expansionary, and everything below 50 is contractionary. So it's still a tale of two different data points. Manufacturing is still a bit weak, while services are still holding up because employment is still fairly good, and hourly wages continue to climb. So I think that's all for our SG Weekly. Maybe we can hit to some of the Q&As first. Thank you.
Hi, I'll take the elite question. Your TP for elite commercial rate is 0.36 versus last trade 0.33. The upside is only 0.03 pounds. May I know your recommendation is still buy? So when we're ready to initiate, the price was trading at 0.24. Yeah. So last week, last week was public holiday, and last week I was on leave. Yeah. So I missed the best time to present, but it's still a buy. Yeah, I'll probably revise the target price after the full year result. The main drag for the share price is actually the risk of breaching 50% of the regulatory limit. But now it seems like very unlikely. Yeah, as they are very actively working on the divestment, and also like the UK side has reached the peak of the hike cycle. Yeah. Hope it answers your question. Thank you. I'll hand over to probably Darren to answer the rest.
Yep, let me get some of the question. Right, they are sharing that prime US rate is higher than its current price. I mean, the target price is higher than its current price. So what's your target price for Manulife and its outlook status? Yeah, so we do not cover Manulife, so we do not have a target price per se. And yeah, for Manulife's outlook, we think that there might be further property devaluations going to happen as of the year-end valuation, but we don't think the impact will be as much as the other two US REITs, because after all, Manulife, they did the mid-year property valuation already, so they already got hit once in the mid-year. So it's unlikely that they'll be hit significantly again as of at year-end. But the thing is, right now they're going through a full a review, and they're in talks with their lenders to seek the waiver for the and they're getting a plan, a comprehensive package. Yeah, kind of a package from the lenders as well as sponsors, and yeah, they're in talks to fix that the breach in gearing. Yeah, so we are just waiting for more updates from Manulife, and hopefully it will come by. Hopefully they can release some significant details by this year. Yeah, but the issue now is to fix the loans, because right now all of their loans are tagged as current in their balance sheet because of the breach. Yeah, so we're just waiting. We are waiting for some updates from them. Yeah, substantive REITs such as CDL REIT and Escort still good, but yeah, we still see upside potential, especially from the improvement in RevPAR. Even though there's RevPAR will likely slow, year on year the growth will slightly slow because of a higher base. The 2023 base was already very high. Yeah, as compared to 2022, 2022 was still quite weak as the recovery in travel and tourism hasn't really fully recovered. And then 2023, we saw like triple digit, 100% year-on-year improvement in RevPAR. And we think going forward, it will unlikely to be, I mean, it won't be 100% year-on-year growth because of the higher base, but we still think there's some potential for improvement in occupancy as improvement in RevPAR, especially from the occupancy perspective, because the ADR or average daily room rates are already very high. So we also think because of this improvement, and it will trickle down to the revenue of all these REITs, hospitality REITs, where the revenue will also improve quite significantly, and this improvement will likely more than offset any increase in interest expenses that they might incur. So we think there's still a good potential for DPU or dividend growth for these hospitality REITs. So we still think these two REITs are still a good buy, but it's more for a dividend play rather than any share price appreciation, because going forward next year there's still higher interest rates for longer, so this will continue to impact the REITs, and we need to see a more significant catalyst, like perhaps a solid decline in the Fed funds rate next year before we can see any significant improvement in share price. That's my view, but we are now overweight REITs mainly because of the dividend yield play. Yeah, just buy and hold and collect that stable dividends. Yeah, so just to follow up on the RevPAR question. Hi, Darren, do you think Singapore RevPAR will continue to grow throughout 2024, or could there be a potential slowdown? Yeah, so for FY 2024, the RevPAR is expected to remain very strong, especially because there are so many MICE events, so many big events coming up, especially in the first quarter next year, FY 2024. There is Ed Sheeran, Coldplay, and Taylor Swift. Yeah, these three concerts are massive, so the tourism inbound will likely be very significant, and the RevPAR will, the average daily room rates and occupancy will likely be extremely high as well. So we think the year-on-year growth for the first quarter will be really solid. And second half, rest of the FY 2024 also, we expect it to maintain the solid growth as all the return of MICE events, etc. Yeah, so I still think for Singapore specifically, the hotel RevPAR will likely grow throughout 2024 as well. Yeah, there's a question. I'm looking for dividend stocks. Is CapitaLand a good fit, or any other stocks you can give good dividends that you recommend? Yeah, so for this, we recommend some of the REITs. Like we have, I think just now in my presentation, there's a chart there. Yeah, we recommend looking at REITs now because we think the interest rate cycle is towards its tail end, the interest rate hike cycle, and we are seeing some good dividends. Like for example, I'll just use perhaps Prime for example. Because of the bombed out share price, right now Prime is already trading at about 27% dividend yield. So if you are a higher risk taker, yeah, perhaps Prime would, and some of the other overseas REITs at Elite as well, trading at really high dividend yields. So yeah, it might be a good fit if you are kind of a risk taker and you can stomach the share price volatility in these overseas REITs. But the local REITs are also trading at some good yields at upwards of 5%, 5-7%. So yeah, so these are some good dividend yield stocks. But for CapitaLand specifically, I'm sorry, Peggy is the one that's more familiar with CapitaLand. I'm not very familiar, so yeah, could wait for her to come back next week to give you a better answer on CapitaLand. Yeah, thanks. For hospitality REITs, which one is a better choice, FEHC or CapitaLand and Scott Trust? Yeah, so these two that are different in a way that CapitaLand and Scott Trust is more geographically diversified, while Five Subsidiary Trust is more focused in Singapore. So if you are perhaps looking for more a geographically diversified portfolio, you might look into CLAS, or if you want just a specific Singapore recovery and like the strong REFI recovery, like in FY24 in Singapore, you can look at FEHC. But personally, which is the better one? We prefer CapitaLand and Scott Trust because of its geographical diversification. It's split of income mix from its stable income sources and its growth income sources. Like they have a master lease base, they have different structures, master lease as well as a management contract. So management contracts kind of will give the upside of the return recovery in travel, while the master lease will have that stable base for them. Yeah, so of those two, we cover Scott, and we think yeah, we prefer CapitaLand Scott Trust. Please explain the 78 cents preference share buyback for city developments. Yeah, so city developments, they announced a proposal to purchase up to 10% of their preference shares through an off-market program. Yeah, so in the end, the result was that it was fully taken up. So as a result, it's about 10% of the total amount of preference shares that was taken up. So about 33 million 33 million preference shares. Yeah, so basically what they will do is they will buy back these shares, preference shares, and then they will cancel it. So they will by doing that, they will save on interest, or rather the coupon cost of these preference shares, as well as it's kind of a strategy for them to have greater control over their capital structure, where they will don't need to pay, because they buy back and cancel the shares, right? They won't have to pay any more finance costs in relation to these preference shares. Yeah, so it's just a small proportion. It's just a 10% only, so it's not very significant. And the reason they are doing this because there's no trading volume as well for these preference shares. So yeah, they're just giving these preference shareholders an opportunity to kind of monetize these assets, or monetize preference shares by selling it back to them, and they just cancel it. So for CDL, they just save on the interest cost. Yeah. Yeah, I think that's all for me. Let me see. Yeah, hand over to Glenn. Thanks.
Hey, thanks, Darren. Yeah, maybe I'll take a bit of a few of the questions. Hold on, let me just take the one on Silverlake first. Okay. Who are Silverlake's main clients in the countries that they have presence, and are the 3 big banks in Singapore using their services? I think there's one more on Silverlake. Okay, I'll take this one first. So yeah, the Silverlake, the big banks they have are mainly, in Singapore, they have 2 of the 3 local banks, so OCBC and UOB. So DBS is not under them. You can draw your own conclusions from that. So OCBC and UOB, OCBC, they recently had that short disruption, right? A few hours, and then they managed to get everything back on. So, some questions, very vague questions were asked. They didn't really answer it directly during the meeting with Silverlake. So what they said was that actually these banks, the core systems are using Silverlake's the SIPS, which is the Silverlake Axis integrated banking solution. But what the banks like to do is that sometimes they will add on things to this core system. So if you see like UOB's Tomorrow app, right? A lot of the nice graphics and everything, that's not done by Silverlake. So it's mainly done, maybe they do it in-house or they outsource it. So, all these additions, where they add on layers, sometimes there might be bugs or errors which cause the systems to sort of have a disruption. So that was how they explained, the recent disruptions it's not really to do with Silverlake themselves, but more likely to do with the banks trying to work around the system and to add additional things outside of it. So, and then in the region, I would say, they have like in Malaysia, CIMB and Maybank, and in Thailand, the big bank, which I was talking about, where they had their first Mobius deal was with Siam Commercial Bank. And in Malaysia, also the other Mobius deal, the 10-year Mobius deal was with Bank. Yeah, so these banks all work very closely with Silverlake. And yeah, I think that's also for the second part of the question, I would say is OCBC and UOB. Both of them use their core banking, Silverlake's core banking system, which is the SIPs. And also, I think I'd just like to add that, when the banks sort of see something like that happening to DBS. So DBS, everyone knows what has happened to them with their technical disruptions and so on and so forth. They will actually come back to Silverlake and say that, hey, we don't want to be like that. We don't want our systems to fail and so off so frequently. So that's also a good thing for Silverlake. It's a positive, because when that happens, then the banks will go back to Silverlake and say, can you please update or upgrade our systems? And the second point also is being, like the anti-money laundering. So with the recent case in Singapore, with the 1 billion AML issue, right? So the banks also go back to Silverlake and say, oh, can you please update our AML procedures to make it more resilient? So, all these will add on to their enhancements and services revenue, which is what we have seen in the first quarter of FY24. I'll go straight to the second question on Silverlake first. On Silverlake, they have an order book, but can you help understand what part of the revenue the order book relate to? Does it include the recurring maintenance revenue? Reason I'm asking is the order book is about 1 year revenue. Cannot seem to see how bullish this order book means to us. Yeah, that's a very good question. So this order book, it actually relates to mostly like, they don't really break it down. So they just give us a round figure. But what we've asked is that it mainly comes, it's all across all segments of the revenue. So what this did say is that 50% is coming from Mobius and Symmetry, which is their cloud-based systems. So you can say that this is partly from that deal, the 10-year deal that they had with Bank, where they are getting sort of not incremental, but like quite steady revenue, where they have to continuously upgrade the systems. So when you look at the newer core banking systems such as Mobius and Symmetry, where it's cloud-based, the initial revenue is actually not as high as if they were to go with a core legacy banking system such as the SIPs. So in SIPs, when they first implement the system, the revenue is the first revenue that they take in is much higher than if it was compared with the cloud banking systems. So this order book actually is both. So there are future core banking systems, which they still do have a few coming in for the SIPs, but there's also the recurring maintenance revenue that is coming in from their cloud banking systems like Symmetry and Mobius. Hope that answers the question. Okay, so now I'll go to the banking questions. I think both of the questions are quite similar. So they're asking, please comment on DBS, UOB, and OCBC, why the share dropped. And also, another question is why the bank's share prices are pulling back. I would say, one of the reasons might be, of course, there are people who are taking profit from when they bought it at a low. So now when the share prices have sort of rose, maybe they're taking profit. So that's one of the reasons. The second reason, is that maybe some people are thinking that the banks have actually hit the cap because interest rates are not expected to increase further. So, what is the growth potential for the banks? So some people, maybe they are thinking that, okay, there's not enough, there's no more growth potential for the banks. But if you look at what the banks are doing, the interest rates are only just one segment, although it's a large segment of their revenue and their earnings. It's only one segment, and they're actually focusing on other ways to grow their bottom line, their earnings. And that is by increasing their fee income, and all three banks are actually doing that. Now even with OCBC acquiring the bank in Indonesia, we can see that all three banks are trying to focus and move further into the region. So both UOB and DBS have the Citibank acquisitions, and they are trying to grow further in other regions, other countries in ASEAN as well as in Asia. So OCBC they're trying to grow very aggressively in China, but now they realize that, okay, they need to diversify. So they also bought the Indonesian bank. So they're also trying to grow into ASEAN. Whereas UOB, I guess, they have that Citibank acquisition all over ASEAN as well as in Asia. So that's what they're trying to grow. And they're also growing their like Tomorrow app and so on and so forth. And then for DBS, I mean, before they had the MAS penalty, they also had their Taiwan, and which that actually added about 10 billion in their loans book. So I say all three banks are trying to aggressively grow their fee income. So they're seeing this recovery. We have seen it in the last quarter where fee income has shown tremendous growth, as well as their loans growth. So loans growth has dipped for the last few quarters, and we have not seen actually any or much growth at all. Even if you look at the MAS statistics, loans growth has been in this like steady decline over the quite a while, almost a bit less than a year. So the other way is that when the interest rate starts to normalize, people the consumers are feeling that the interest rates have peaked and there's no, they have no choice. So we might see a further increase in the loans growth, and that will also boost their bottom line because the net interest margins have sort of capped. And housing loans have also been very positive for all three banks, and even from the MAS statistics as well. Then there's one more question on IFA. So they ask, okay, maybe this one, I think this one is a technical question, sorry. Yeah, so I'll leave that to Sein. I think, okay, there's one more on the Nvidia. I think that one I'll leave it to John. I think it's directed at me, but I think John is the one who covers Nvidia, so I'll leave that to him. Okay, that's all for me for the banking sector. Yeah, I'll hand it over to the rest of my colleagues. Thanks.
Thanks, Glenn. Yeah, so I'll take a couple of questions, both on Nvidia, I think. So the first question is, for Nvidia, how much of the sales jump in the last 2 quarters comes from possible Chinese buying ahead of restrictions, therefore distorting or exaggerating its growth trajectory? Yeah, so I think a small portion of it is that, yes, but at the same time, when you look at guidance for next quarter, and then this is already stripping out, essentially all sales to China. On a sequential basis, the revenue is continuing to grow. On a year-on-year basis, it also continues to accelerate. So it is possible that a small portion of it was just Chinese consumers buying, or rather Chinese customers buying a little bit ahead. But I think the biggest story is just more of a global transition to accelerating computing. More and more people are getting into this, and there's just such a demand from basically everywhere else other than China. I mean, Chinese demand is still strong, but when you have demand from basically all parts of the world, it helps to offset a little bit of the decline in just one geography. And so that, I think, is basically what we are seeing right now for Nvidia. So that ties into the next point, which is Nvidia is planning to redo one of for China market with its H100 chips. Will they improve financial results? Yeah, so actually they redid it to it's called H20. So just a backstory on the restrictions. Essentially, what the US government did was they placed restrictions on, rather requirements on technology. So essentially, the best technologies have the strictest requirements and the strictest licenses. So essentially, if you're making really high-end technology like Nvidia does with their H100, then you're going to need to get all these licenses, and it's very difficult to get these licenses from the government. And then as you start going down the chain in terms of performance of your products, then the requirements are less and less and less. So essentially, what the H20 does, how they built it is it's like half the efficiency of H100. And it doesn't meet the requirements for the need for licensing. So they're able to sell it to China just as is. And for the Chinese buyers, they don't really have a choice right now, because if they don't get their chips, they can't move on with their their investments in AI and stuff like that, because they don't actually have a solid replacement yet. They don't really have a substitute from the Chinese market right now. So they really don't have a choice. They just got to take it. But that being said, this won't really significantly boost Nvidia's financials, because it's not as, obviously, once it's not as good a product, you're not going to be able to sell it for as much. The margins won't be as good. And essentially that's been baked into the guidance. Management has actually even said that they don't expect contribution from from China to be that significant at all, even though they are going to start selling these H20 chips there. Yeah, so that's why the Chinese market is a little bit bleak for right now. But the good news is that demand from everywhere else is offsetting the weakness from China. So it's kind of I guess essentially it's kind of an afterthought for right now. Yeah, hope that helped to answer your questions. There's another question here on STI. I think I can try to take that. Team, your comments on STI have been weak for the last few weeks. What needs to make it turn around? Yeah, so essentially, like both Glenn and what Glenn and Darren have said, I mean, when you look at the composite of your STI, most of it are your banks and your REITs and some of your conglomerates like SIA, Singtel, and so on. For the REITs, I guess the whole narrative is surrounding like interest rates. With your higher interest rates for longer, you don't really know when this will turn around, and therefore that won't really help the banks in any way, the REITs in any way. You really got to get the interest rates coming down for REITs to start being attractive again, on a much larger scale. And then from the bank's perspective, like what Glenn said, because most of the growth has been driven by your expanding NIMs because your interest rates are continuing to climb. But we've kind of reached a ceiling for interest rates, and the only way it's coming down. And so I guess the market has priced in a little bit more negativity because there really isn't that much I guess significant growth drivers aside from that, at least in the near term, although like you mentioned as well, a lot of the banks are diversifying, so we should we should see these kind of efforts pay off a little bit. But for right now, I think the market is just pricing in a lot of I guess the negative impacts of, number one, higher rates. Number two, the rates have kind of reached a cap. Yeah. And then for the other conglomerates, economic activity hasn't really been great. A lot of the export numbers are still fairly equal demand from around the world. Isn't as robust as it was expected to be. So that's probably why STI and our comments already have been quite weak for some time right now. Yeah, so hope that helps to answer your questions. I think that's all for me. I'll hand it back to the rest of my colleagues. Unfortunately, Paul and Peggy are not here, so they can't answer your Singtel, Thai Bev, your Top Glove engine thing. Yeah. So maybe when they're back, they can kind of ask them those questions. Yeah. All right. Thank you.
Yeah, thanks.
Let me take on this last one for Silverlake first. Yeah, thanks. So anyway, yeah, someone asked a very good question. Hi Glenn, your positive view on Silverlake sounds very convincing to me as well, but the share price just does not move up and dividend is also not attractive. So what's the motivation for investors like myself to buy the shares? I would say, with Silverlake, it's more, it's not so short term. So you won't see the growth suddenly go up incredibly. It's not very volatile. Their share price is quite stable, right? So you're right about that. And dividends also, yeah, it's not very attractive. So what is the motivation? I would say the motivation is, to catch it early, because this new cloud-based core banking systems for banks is actually not very widely known, or is it really very widely used across the banks? Because banks they look at sort of like historical performance. They look at the product and then they go like, okay, this let's say we look at SIPS, which is the legacy core banking system, and they look at it and say, okay, it has worked quite well, right? They have sort of shown in the past where they did so many banks and it's secure. Security is the number one, right, for the banks. So it is very secure and it doesn't fail, right? So maybe some of the new banks, they're looking at, they'll be like, oh yeah, maybe I'll just go back with SIPS, right? Because they have a board of directors as well as compliance to ensure that it's in line. But with this cloud-based core banking system, I guess it's still in its infancy, where they are trying to show the proof of concept, and they've done it with Siam Commercial Bank. So some commercial bank has adopted this Mobius, this cloud-based systems quite well, and they have actually shown that it works, and it's also very secure. It has been going on for quite a few, I think a few years already. And then now they also have this new Malaysian bank, which is the Affin Bank, and they have signed a 10-year deal. So I guess, with these two, they are just trying to prove to their main consumer base that actually Mobius and cloud-based core banking systems do work, and it's just as secure, but yet more effective and more efficient than the legacy core systems. So it's when the banks actually do this switch where you will see this huge uplift for Silverlake Axis, especially in their maintenance and enhancement services revenue. So I guess, it's really quite hard to pinpoint when exactly this will happen, because the banks need to firstly not just convince them. The Silverlake doesn't just need to convince the banks also need to convince themselves and their board of directors to do this switch. And I guess when you start to see more and more major banks using this new system, especially when I mentioned earlier that there's several banks are seeing end of life for their legacy core banking system. So it's not SIPs, right? But I cannot really say which system is reaching the end of life. But quite a few banks, from what we have heard, is that they're reaching the end of life. So the banks really have not much of an option. They need to change to a new system, because the old system, maybe they'll get an additional 1-year extension to continue on with these core systems. But they are sort of aging out already. So they're getting outdated. So they need to do this refresh. And when this refresh comes in, right, it might take 1 or 2 years. It's really hard to say. But when this refresh kicks in, then Silverlake will suddenly get a lot more like very serious inquiries to say, okay, we really need to change now. And now might be a good time, because based on what they've done with Siam Commercial Bank and Affin Bank, that we might need to use this new Mobius or even the Symmetry platform. And I guess that's when you will start to see much more intake for their new systems. So I guess for Silverlake, it's not really looking at their core legacy. If you want to look in the future and both medium term and long term, it's not the core legacy, which is SIPs. It's really looking at their new cloud-based systems. So I hope that is enough motivation for you, for Silverlake Axis at least. Okay, I think that's all. Maybe I'll hand it over to Zane for the technicals. Thanks.
Okay, thanks, Glenn. I'll start with the technicals. Okay, so first up will be on DBS. Okay, DBS has been trending downwards in this descending wedge recently. We also retested support around 31.90, but it looks like currently it's unable to find support over there. So I think for DBS, if it continues to the downward trend, given the weak momentum we have now, potentially it could go maybe a lower to test like 31.40, 31.50, the area over there before we see some support coming in. Okay, then the next would be Seatrium. Okay, for Seatrium, currently I think it's just still mostly just sideways over 2 weeks plus. Yeah, so I think for now, it looks like it's a current trend. Unless we see a breakout this main downtrend resistance line over here, then maybe it could go up to retest some higher levels like 0.112, 0.15 around there. Okay, then next one will be on Netlink. Okay, for Netlink, I think probably just range trading. Recently, there was a breakdown of this 82 cents previous support level over here. Then it went down to retest the older support of 79 cents. It's just just trading in range for now. So I think that will probably continue for Netlink. Then there's a question for Singtel. This price can buy. Okay, for Singtel, I think mostly just range trading for now. It's just in this range since August. So for now, it's still around the support at $2.25, $2.26. yeah, there might be some support around here as shown in previous times. But there's some, I think there's some short-term resistance closer about 230 to about 233 over here. Yeah, so I think for Singtel, there's a rebound that's still likely to be some range bound trading over here. Yeah. Okay, then for the other two banks will be UOB as well as CBC. So UOB has also been trading in this downtrend channel over here. So I think just for the past week, it's just been sideways. So yeah, I think we need to see how it goes. Whether they manage to break out of this channel, the next resistance will likely be around 2770, 2780 around there. If it continues the downwards momentum, then we're likely to see it go closer to about 2690 for the next support. Yeah, so that's for UOB. Okay, then for OCBC, yeah, OCBC also just another retest of the support around 1260 around there. So yeah, it's just been range trading. It's still is the strongest among the three banks for now, but yeah, it's still lacking momentum. I need to be a range trading. Let's see whether we get some support around this current level around 1260. Yeah. Okay, next up will be on Capital Corp. Okay, for Capital Corp, I think mostly sideways for now. There's price just been consolidating over here. Still I need to break above this resistance around 650, but the signs are the positive signs are that a higher lows have been formed. Let's see whether the price is able to hold around the 630 mark and do a bit of a range trading. Then maybe there could be some reversal upwards in future. Okay, then next one will be on city developments. Okay, city developments I think is still downtrend over here, but recently just sideways. So potentially that might still continue for now. I think yeah. Yeah, with the resistance currently around 630, there's some support around 615, 6 to 615 around. Okay, then for CapitaLand investment, I think for now, it's just sideways, still very much sideways, trying to break out this downtrend channel over here. So yeah, let's see whether the support over here still hold. But the positive is that it's been forming higher lows. So looking around, if it's like the $3 mark is still holding, then let's see whether it can try to break out this range in future. Okay, then for Genting Sing, I think currently it's just pulling back after a very strong spike over here. So chart wise, it looks like the breakout of this 89 cents level over here. So currently we are around retesting a first level of support around 91 cents, which was this previous range support over here as well. Yeah, so and then next support will be a retest of the 89 cents mark. So I think for Genting, currently it's trending upwards in this stretch, but just not is likely to be a pullback. See whether there might be some range starting to form for Genting. Yeah. Okay, the next one, Fraser Logistics Commercial Trust. Okay, for FLCT, looks like it's trending upwards in this rising wedge for now. So currently I would think yeah, it's just gonna trend in this wedge. Support around 108 to 109. Resistance likely to be around 113 for now. Okay, then TA for STI. Okay, for STI, I think it's still quite weak. Still I think yeah, it's still trading in this blue color downwards wedge over here. We see, and then we look at the longer term trend since it started. declining since August. We have seen lower highs, lower lows along the way. So yeah, currently we are just hanging around the 3090 level, which was prior resistance, now acting as support. So for now, currently just some sideways action, but if we can't hold, we do go lower, we could see a retest closer to 30,040. So STI still showing weakness for now. Unless the weakness for STI, I think likely to still be around unless we see like a breakout of this wedge and also price recovery of this 3150 level. Okay, then next up will be iFast. Okay, iFast, I think just some slight pullback after a very strong run. So it hit it decided to pull back after hitting around close to $8, one of the resistance in the past. Yeah, so for now there could be some short-term pullback to try and retest some support around close to 750. There might be some support around there. And second support level will be around 720 for iFast. Reversal for glove manufacturer. Okay, I'll talk about the chart for Top Glove since there's some volume recently. Okay, so for Top Glove, the positive is that there was the price after a sideways over here, it managed to break over the 23 cents level, which was a key support and term resistance. Now there was a breakout. So it entered the 25 cents level again. So currently there's some short-term resistance. There could be some short-term resistance over here. Price could see some sideways. But I think if we do see higher lows form along the way and above the 23 cents mark, then this short-term reversal could continue to try and test the higher resistance closer to 27 cents in future. Okay, then what's your lot of CMOU? Okay, I'll share the TA part of it, Apple Pacific Oak. Okay, so for this is currently after retesting the 31.5 cents resistance, currently we are seeing a pullback. So I think for now, it's quite near a support zone, which is around 27 cents to 28 cents, likely to find support at this area. So I will expect some rebound for Apple Pacific Oak over here. We try and do a bit of a range consolidation after a run over here. We gain on Adobe as well as Netflix. So for Adobe, I think it's pretty strong. We saw after a breakout of 570 over here, it's been trending up in this uptrend channel over here. So I think we also saw short-term resistance levels being broken around 615 over here. So looks positive for now still. I think could still trend higher if we do keep within this channel itself. The next resistance likely to be around mid-630, where it was a previous support breakdown back in 2021 over here. And for Netflix wise, okay, Netflix is also very strong, just inching up slowly every day. Then I think we will see a retest of the 485 year high level over here for Netflix soon. But it could still continue to go higher since that there was a gap over here, so not much liquidity over here. So if it does take out this level, potentially it could still go higher to try and retest the next resistance around 500 over here, which was a previous support as well as resistance. Okay, T for SAM Industries. Okay, for SAM Industry, I think there was a potential breakout of this bullish panel over here following a breakout of this descending wedge. So yeah, if price decides to trade hold at a 509 level over here, potentially could still trade higher to try and retest like 520s and followed by the higher resistances at 550 to 560s. Okay, then as for Manulife US REIT. Okay, Manulife, I think some consolidation after a strong run. Met resistance at the 0.102 level with price support. And it's currently acting as resistance. So for now, I think some sideways. Near-term support we are around the 0.090 to 0.093 levels. Yeah, so I think some consolidation for now. Okay, then moving on to the Hong Kong counters. First one, Tencent. Okay, Tencent I think is still just range for now. But good thing is still holding above this 315 resistance level. So yeah, looks like whether we see a breakout of this key downtrend channel over here still waits to be seen. But yeah, just looks like some consolidation still for now. Okay, then for Alibaba, it's still in downtrend over here. Recently price just some sideways trading, so maybe that will continue for a while. But I think still likely to show some weakness with near-term resistance just quite nearby around the $79 mark. Then 2801, this background asset management North Asia, iShares MSCI China ETF. Yeah, so for this, I think it's still in trading in possibly this descending wedge over here. We're still seeing lower highs being formed. Support mostly around 1780. Yeah, so likely we just see some continued consolidation for this ETF. Then 3191 will be this mirror asset global China semicon ETF. Okay, so for this looks like a bit of a range trading going on. So yeah, a broad range is from around 34.50 to about $39. And recently price managed to break above this 37 mark. It's also stay above, so yeah, it's forming another range over here. Inside this bigger range. So I think for now there's still some consolidation going on. Okay, next one will be SIA. Okay, SIA, I think following the breakout of this downtrend channel over here, it's trading in this short-term uptrend channel over here. So yeah, good. It's still looking positive. Near-term wise, there could be some resistance around 640, this swing high. But if it clears, then could go towards 650s over here. And then as for sets, okay, then sets. For now, there's still some resistance around 270s mark. So yeah, price was unable to hold on, but so possibly we could see a retest of around 260 and before it decides to get some support around here. Okay, then next one will be DFI. Okay, DFI I think is still downwards trending over here. You can see in the longer term trend. Recently it did a retest of the prior support breakdowns around 240. but looks like it's turning back down again. And this short-term swing low was able to hold around 230. So and price has decided to go lower. So that I think still looking a bit bearish, or potentially we could see retest of the swing lows close to about 210 to about 215 over here. Okay, then for Hong Kong land, I think it's still just range trading going on, but I would expect some resistance ahead of this support breakdown as well as this junction resistance line. So around 340 to about 340, 340 to about 350, around that, we still continue to see resistance. So I think for Hong Kong land, probably just some continued range consolidation for now. Before JMH also just still range consolidation going on. I think. Yeah. Okay, then I'll move on to some of the tech names. First one, Franken. Okay, Franken, I think generally just range is a range over here. Recently some resistance still at 115, also at 119. But near-term support-wise, there could be some support at around 110 as well as 106. So I will expect some still range trading going on. And as for AEM, I think still looking quite bearish. I think recently just did a retest of this bearish flag breakdown, as well as this was a previous support around 340s, 350. So then resistance. So price is turning down again. So I will expect AEM to try to retest the recent lows around 310, 315 for some support. Okay, then UMS, I think yeah, around a bit similar to Franken, the chart, I think. Yeah, so it's just some range going on. There's some a support at 124 and so at 120. Yeah. But price still on recent resistance will be around 129, 130 over here. Yeah, so I think that's all the key questions for me. I'll pass on time to my colleagues. Thanks.
Thanks, Zane. So let me try and answer a few more questions here. There's a question here. Do you have an outlook for USD in 2024? And is it better to hold USD and fix D or equity or switch to Singapore stocks? Yeah, so unfortunately, we don't really have a official outlook for the US dollar. But I guess in my own opinion, I don't expect the US dollar to really strengthen that significantly, nor do I expect it to weaken that significantly, mainly because there's we don't really see, or we don't expect to see a lot of fiscal stimulus or anything like that. But at the same time, it's kind of like status quo right now. And so what's likely is going to happen is that it might go up a little bit, but don't think it's going to be that significant in terms of US dollar. Right now, I think if you hold US dollar fixed, you get like 5% plus minus a bit. So it is quite attractive if you have it in just your local fixed D accounts, or rather your USD fixed D accounts here. We still think that equities are a little bit overvalued as a whole. So if you can get 5% on risk-free, that's definitely a little bit more attractive compared to the overall market right now. Yeah, but that being said, obviously if you you are comfortable, picking individual equities that have strong cash flow and who probably outperform, like especially like your big tech guys, then you can always do that. Yeah, hope that helps. There's another question here. Last week SMIC was saying the semicon recovery will be delayed further by another year due to geopolitical situations. Do you concur with what they said? Yes and no. So that's a very overarching kind of statement. Because the semicon industry is so big. It's like no one's going to tell you that the GPU guys, the data center GPU guys, are not recovering because they're just going crazy. It's just AMD and Nvidia. But when you look at the other, kind of, I guess, subsectors like your foundries or your not even that, but your CPU chips, your memory chips, all these aren't really doing that well because they are very connected to a lot of your tech hardware, which is extremely cyclical. And so I think there'll be pockets of your semicon industry that'll be doing well. Your GPU guys, a lot of your I guess embedded chips that you find it in your EV cars, those will probably continue to do well. But yes, as a whole, we would expect the recovery to be very slow, very gradual. And mainly because there are a lot of headwinds for everything other than AI in the semiconductor industry. It isn't really looking that great. Whether or not that's due to geopolitical issues, maybe a little bit, but in general, I think a lot of it just demand isn't quite there at the moment. So, if demand's not there, then recovery is just a lot slower. Yeah, so hope that helps. There's another question here. Do you think there'll be a year-end rally this time around as recession is still looming next year? I want to say it's a bit unlikely. If you look at the US markets, November is up like 11%, something like that so far. So it's going to be very difficult for the market to continue running into next month. I mean, just historically, that's just not really the case. So, worst case, or rather best case, maybe 1 or 2 percentage points up, which is still pretty decent. But I'm not sure if you'll be able to get a center rally for this coming year. Maybe the center rally has already come over the last month. Yeah. I don't think recession has really anything to do with whether or not it will rally in December. There's a last question here. Based on historical data and events, what is your view on US market from now till November next year as the US presidential election is? Yeah, so in general, pre-election years are great. Election years are also great. Not as great, but still pretty good years. But I think it's very difficult to tell right now because there's a lot of uncertainty. Macro-wise, globally, it's still fairly weak. You've got this Middle East conflict going on. You've got still some of your China-US trade tensions, and you saw or you are seeing right now a very huge rally in the US equity market. So whether or not, and this rally isn't really proportional. A lot of it is still due to a lot of your bigger companies. So broad-based recovery is still kind of questionable. I think earnings outlook for the other 490 companies are not that spectacular. And so whether or not the rally into next year will be sustainable is a big question mark. Based on what we are seeing right now, we think it'll be a fairly decent year, but nothing, by decent I mean 5%. That's just an early prediction for next year. Assuming there's no recession. I mean, if there's a recession, then definitely you'll have kind of a rough. But yeah, I think it's a bit too early to tell. There's a lot of moving parts. Still a lot of weakness. But some bright spots as well, but a lot of weakness. Yeah. Hopefully that helps. I know it's a very non-committal answer, but it's very difficult to kind of gauge, especially with what's going on right now. That's basically it. There are a couple more questions. I think Sean, are you here? I think there's a question on SSB. Maybe you can help answer this. Oops, I think Sean's been having some technical difficulties. Maybe I can get him to answer this question and post it for P3 community. So you can probably see the answer there. Yeah. So sorry, apologize for that. But anyway, I think that's pretty much it for today's session. I do apologize again. Peggy and Paul are here to answer a lot of the questions on Thai Bev and so on. But I just want to thank you guys for joining us today. We hope to see you next week. Have a good week ahead. Just a reminder that next week will be our second last webinar for the year. So I think we'll stop the 11th of December will be our last one. And then Morning Note will stop at the end of that week. But yeah, so thanks for joining us. Hope you have a good week ahead. See you.